Did you know that around 40% of the over 70 million Social Security beneficiaries end up paying some federal income taxes on their hard-earned benefits? The benefits that they earned after decades of working hard and paying lots in taxes to support this government pension. It's true. Those benefits can end up being taxed even though they are the product of your taxes. But don't worry. By the end of this video, you'll be a pro at navigating the complex world of Social Security taxes. Welcome back. For those of you who don't yet know me, my name is Steven Spicer, and it's my goal to help you not get killed in taxes and be as prepared as possible for whatever your future may hold. In this video specifically, we're diving deep into the often confusing world of Social Security taxation. As a financial advisor, I've seen firsthand how understanding the ins and outs of Social Security taxes can make a big difference in your retirement planning. So buckle up, grab a notepad, and let's get started. So what exactly is Social Security benefit taxation? In a nutshell, the taxation of Social Security benefits, which, by the way, if you're curious how your benefit is calculated, you should watch this detailed video. But anyway, the taxation of your benefits refers to the federal and state income taxes you might owe on your retirement or disability benefits. The portion of your benefits subject to federal taxes depends on your total income from all sources, which the IRS calls your combined income. Your combined income is calculated by adding your adjusted gross income, AGI, non-taxable interest, like from tax-free municipal bonds, and half of your Social Security benefits. If this total exceeds certain thresholds set by the IRS, up to 85% of your benefits could be taxable, from 0 to 85. Now, 85% is an alarming figure, probably more alarming at first than perhaps it should be. During your working years, you're used to seeing these percentages when talking about taxes pretty much as the amount that the government is going to take. Maybe you're in the 24% tax bracket or the 35% tax bracket, and you can do the mental math. For every $10,000 I make, they're taking $2,400 or $3,500 of that, leaving me with the rest. Well, in this case, luckily, this percentage is not being applied as a tax rate, but rather it's being used to determine the amount of this monthly payment that you receive in a given year, the percentage of that will be applied to your taxable income for that year. So in this case, when they say that 85% is taxable, for every $10,000 in Social Security income you received in that given year, the government is going to tax $8,500 of it at whatever your tax rate happens to be that year. But still, bottom line is, if we can get it to where they tax none of it, $0 of each $10,000 worth, or at least less of it than 85%, yeah. Let's do that. We're gonna build your knowledge base here so that you can know how to make that happen. Now let's break down each component of this combined income a little further. Adjusted gross income, or AGI, this is your total gross income minus specific adjustments, such as alimony payments, student loan interest, and certain retirement account contributions. Your AGI doesn't include deductions like charitable donations or mortgage interest, which come into play when calculating your taxable income. Non-taxable interest. Even though interest from certain investments like municipal bonds isn't taxed at the federal level, it still counts toward your combined income for Social Security taxation purposes. This is important to keep in mind when planning your retirement investment strategy. And then the IRS randomly includes 50% of your annual Social Security benefits in your combined income calculation. But wait, there's more. In addition to Uncle Sam, as of this reporting, 9 states also want a piece of that Social Security pie. Now, that's becoming less and less common. That's down from 11 last year. But still, if you live in one of these states and your income tops their specific, unique thresholds, you might owe state taxes on your benefits too. Make sure that you or your trusted advisor is factoring this into your plans. Here are the states, so that you know if you need to do that extra bit of homework after this video. Anyway, here are the states: Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. Now you might be thinking, why on earth are they taxing my Social Security? I paid into this system my whole working life. Well, I don't disagree with you. And it would seem the government didn't either when the system was first implemented, because at first they didn't tax it. The biggest reason the government does this today is that taxing Social Security helps fund the program itself, and it needs the money. As more and more baby boomers retire, fewer workers are paying into the system compared to the number of people collecting benefits. In fact, the ratio of workers to beneficiaries has fallen dramatically over the years. Back in 1950, there were about 16.5 workers for every Social Security recipient. Today, that number has dwindled to less than 3 workers per beneficiary. Taxing those benefits helps bridge that gap and keep Social Security afloat for current and future generations. Sounds like just a band-aid to me, an unsustainable one at that, but that's a conversation for another time. Now, I like learning from history. Here's how it went down. The taxation of Social Security benefits began back in 1983 under President Reagan. At the time, the Social Security trust funds were facing a financial crisis, and lawmakers were looking for ways to shore up the program's finances. The 1983 amendments to the Social Security Act introduced the taxation of benefits for the first time, with up to 50% of benefits subject to federal income tax for higher income beneficiaries. Here's how it worked. If your combined income exceeded $25,000 for single filers or $32,000 for married couples filing jointly, you'd have to pay taxes on up to half of your Social Security income. It's worth noting that these thresholds were never indexed for inflation, which means they've remained the same since 1983, even as the cost of living has gone up significantly. Fast forward just 10 years to 1993, and President Clinton signs legislation creating the tiered system that we know and love today. The new rules allowed for up to 85% of Social Security benefits to be taxed. Again, these thresholds are not tied to inflation, so more and more retirees have found themselves and will find themselves subject to these taxes over time. And now we have a repeated precedent of increasingly taxing your Social Security benefits. So, who knows exactly what the future might hold? This, by the way, is called public policy risk, and it's just one of the major risks for which you and/or your trusted advisor needs to be prepared. All right, let's get down to brass tacks. To get a rough idea of how much of your Social Security is taxable, you need to know 2 things: your combined income and the applicable IRS income thresholds. We've already covered combined income and part of the thresholds, but let's take a closer look there. For single filers, if your combined income is between $25,000 and $34,000, 50% of your benefits are taxable. If you're over $34,000, it's 85%. For married couples filing jointly, the 50% taxable range is $32,000 to $44,000, and the 85% kicks in above $44,000. And again, these are not indexed for inflation, so unless they make specific policy changes, these numbers aren't changing from year to year, like many when it comes to your retirement planning. Now, in practice, the exact formula here is unnecessarily confusing. IRS Publication 915 walks you through determining your exact rate. It looks like this. I'll link out to it in the description. In short, if you find yourself way above those thresholds, you can expect roughly 85% of your benefit to be taxed. If you can manage to stay below those lower thresholds, as you might be able to with some thoughtful long-term tax planning, you might just save yourself from any of it being taxed at all. But anyway, whatever amount, according to that worksheet, is determined to be subject to taxation, that will be added to your taxable income and then taxed based on whatever your tax rate is for that given year. This unique, progressive, sliding scale nature of this tax causes it to sneak up on countless unsuspecting retirees each year. It creates what has been dubbed a tax torpedo, effectively a tax surprise that can cost you tens of thousands of dollars. I outlined that in more detail along with 2 other costly tax torpedoes in this video. If that all seems complicated, it is. As I pointed to earlier, the IRS provides those worksheets and calculators to help you determine the taxable portion of your benefits. Or if you have a complicated enough scenario, Your financial advisor should be helping you with these things. The key takeaway is that if in any given retirement year, you are at all close to either of these combined income thresholds, proper planning throughout the year, thinking about from which accounts you're pulling funds, for example, whether those withdrawals are going to increase your taxable earnings or not, that can all have a meaningful long-term impact on your financial plan. Remember, distributions from traditional IRAs and 401ks and other tax-deductible accounts are included in your AGI. The money, contributions, and growth inside these accounts has never yet been subject to taxation. When you take distributions, they're taxed as ordinary income and can significantly impact your combined income and thus the taxability of your Social Security benefits, potentially triggering these tax torpedoes. There are, however, some income sources that don't affect your Social Security taxation, like Roth IRA distributions, life insurance proceeds, inheritances, and certain other payments. Roth IRAs have been funded with after-tax dollars, so you can generally withdraw your contributions and earnings tax-free in retirement. Since these distributions don't count towards your AGI or combined income, they won't increase the taxable portion of your Social Security benefits. This is where long-term tax planning comes into play for your financial plan. By being intentional about which account you pull from and when throughout retirement, you can save yourself 6, sometimes 7 figures worth, not even exaggerating, of avoidable taxes. Not just talking about this type of Social Security planning, but other tax planning areas as well. The concepts in this video are just one piece of a much bigger, holistic, long-term tax planning puzzle. We'll get to all of that, we're building. Other income sources that don't count towards combined income for Social Security taxation purposes include veterans benefits, workers' compensation benefits, supplemental security income, SSI, disability income from a private insurance policy, and proceeds from a reverse mortgage. It's worth noting that while these income sources don't directly impact the taxability of your Social Security benefits, some of them may still be subject to federal and/or state income taxes on their own. It's always a good idea to consult with a tax professional to understand the specific tax implications of your various income streams. There's one more thing you should consider as you navigate this world that is your taxable Social Security benefit. Since a portion might be taxable, you have a decision to make. Should you have taxes withheld from your monthly benefits or not? There is no mandatory withholding for federal taxes, so it's up to you to decide what works best for your situation. The same goes for your state taxes. If you live in one of the 9 states that tax benefits, you'll need to contact your state tax agency to see what your options are for voluntary withholding. In my experience working with thousands of clients over the years, people do not like tax surprises. They would rather withhold payments to avoid being hit with the large tax bill later. Their goal is to get as close to not having to foot a bill come tax time as possible. At the same time, they don't want to give the IRS a large interest-free loan either, what would ultimately result in a refund. You can work with a tax professional or a certified financial planner to figure out what would make the most sense for you, given your unique situation. In order to start federal tax withholding from your Social Security benefit payments, you'll need to complete IRS Form W-4V. There you can elect a withholding percentage that best aligns with your effective tax rate. Your options are 7, 10, 12, and 22%. Regardless of whether you choose to have taxes withheld, you'll report any taxable Social Security income when you file your federal return each year. This is where the rubber meets the road and you settle up with the IRS. You'll use Form 1040 to report your taxable Social Security benefits, along with any other income you received during the year. The amount you'll owe depends on your total taxable income and applicable tax bracket. Then you can reconcile any taxes that were prepaid via withholding against the total amount due. If you had too much withheld, you'll get a refund for the overpayment, but if you didn't have enough withheld, you'll owe additional tax, which is due by tax day, usually April 15th of the following year, along with your return. I sincerely hope this video helps you understand how your Social Security benefits can be taxed and the financial planning opportunities that exist as a result to help you pay as little as legally possible to the IRS and keep as much of your hard-earned money as possible so you can truly live your best life in retirement. I look forward to helping you more in the future however I can. I wish you all the best. Take care.